I'm Barry.
I'm Steve. Barry, what's our hot topic today?
Today we're talking about high cash value whole life and why you need a paid up additions rider. But guess what? There's a problem. Most life insurance agents out there are designing whole life policies incorrectly. If you look at a traditional whole life policy, you'll find that all of your premium is going into what's called base. This is what's purchasing the life insurance. So if all of your premiums going into base, you're going to have very little cash value growth. So guess what? If you want a properly structured high cash value whole life policy, you need to reduce the base premium. Here's what that looks like. We're going to cancel out the base premium completely here. And we're going to change this, Steve, so people can see now a high cash value whole life policy.
Exciting stuff, Bear. So this means that when a lot of people are commenting on whole life insurance, they're commenting on something that is probably quite different from what you're demonstrating right now. Correct?
Exactly. You hear the financial entertainers that talk poorly about whole life insurance, and it's typically because a person's premium is all going into base. So what we want to do is we want to minimize the base as low as possible and add what's called a paid up additions rider, or PUA for short. And this PUA is growing cash value. You'll sometimes hear, well, I want to do a 90-10, or I want to do an 80-20, or I want to do a 70-30. This is the split, meaning 70% of your premiums going to PUA, 30% to base, or 80 to PUA and 20 to base, etc. But there are differences here in that with your 90-10 split, you're going to have amazing first year cash value. But as time goes on, that cash value may not perform as well as, say, an 80-20 or a 70-30. But the focus is the majority of your premium should be in PUA and a small portion in base. And this allows a person to maximize their cash value growth. And why would they want max cash value?
Right. They want to take advantage of the 7702 treatment, the tax advantages, and the whole reason that it's limited, right, Barry, is because it's a good deal from a tax standpoint to have that extra cash in there.
That's right. This can replace a 401k, an IRA, a mutual fund. We're not telling people to get out of the market, but what we are saying to people, if you want to grow your money guaranteed, have access to liquid cash, and potentially take all this money out tax-free, we can show you how to do that. So high cash value whole life policy must have a paid up additions rider.
Right. Barry, one question. Do you have an approach as to how you determine 90, 80, 70%, the blend?
Great question. What I'll do is I'll show clients 2 or 3 different illustrations from some of our top whole life insurance companies and let them decide, and it's all based on their goals. Someone may say, hey, I want as much cash value as I can get in years 1 through 4. And others might say, no, I want more cash value 10 years from now, 20 years from now. I'm looking at as much tax-free retirement income as possible. That will determine the 90-10 or the 80-20 or the 70-30, but always it's based on a client goals.
And it's case by case. So if somebody's saying, I always do a 90-10, maybe there's something to look at with that, correct?
Yeah, we shouldn't use a blanket statement to cover everyone out there. We want to look at it case by case for someone's goals. So
awesome.
Yeah, click the button below. You can get more information. You can schedule a call with us. We want to help you achieve a high cash value whole life policy where most of your premiums going to paid up additions and not to buy a bunch of life insurance.
Right. Go PUAs.